Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Back with another stock review today. It is one that we hold in Crassus Investments, our portfolio on eToro that's available for public viewing and investment to the public. So we're going to talk about Cenovus Energy today, and as the headline suggests, 30% free cash flow yield, at least at the time I started making the video. If you haven't already liked and subscribed to the YouTube channel, I would greatly appreciate you doing so. It helps me to get more of these videos out there and get an understanding as to the types of videos that you would like to see and get value from. Without further ado, quick recap of the Crassus investment formula. If we're looking to hold a stock for the mid to longer term, we're looking for a stock with low debt, margin of safety, sales growth, strong margins, free cash flow growth, definitely, and ideally share buybacks. So that's what we're looking for, and that's the formula through which we run a lot of these investment ideas. Some facts about Cenovus. So the revenue is tipped to come in at about 33 billion by the end of this year, 10% top line annual growth over the last decade, which is pretty good for a company that size. 6.7 billion in EBITDA at a 9% CAGR, $23.7 billion market cap. Okay, with an enterprise value of $35.7 billion. Price as at the time of recording is $11.74. 2 billion shares on issue, and we've also had 208 million in buybacks over the last 12 months. Okay, as a pound sign should be $1. Okay, it's a NYSE listed stock. Dividend yield 0.5% and return on capital about 5% using 2019 as a guideline, because 2020 was obviously such a weird year for the oil and gas producers. Net debt to EBITDA is a little bit high, but they can easily take care of that with their free cash flow generation, and the company plans to pay down that debt quite quickly over the next few years, straight out of the free cash flow, which I believe they will succeed in doing so. Some key points. So it's a major player in the Canadian oil and gas space, and it will have the largest refining capacity upon the acquisition of Husky Energy. Okay, so recently acquired Husky Energy. The annual synergies are expected by analysts to be about 1.2 billion. So they're going to be able to increase their margins by taking advantage of the synergies that can come by rolling up or consolidating companies and streamlining the expenses of the new and improved entity. The break-even price is at $36 West Texas Intermediate. Okay, so if oil is stable above $36, they're making a lot of money. Okay, 2022, their expected free cash flow to enterprise value is yielding about 16%, which is fantastic. I prefer to use free cash flow to enterprise value because that takes into account the debt of the company. So companies can sometimes trick you with this sort of 30-40% free cash flow to market cap. Okay, so the expected free cash flow next year over the market cap or the share price will give you this really high number. But don't forget, a lot of these companies are very highly leveraged. So it's also good to use the enterprise value so you get a true indication of, if you account for the debt that the company is holding, what is the true yield on the free cash flow on the entire enterprise value, okay, which at 16% is very, very good. It's also trading at about a 1x book value, okay, which is absurdly cheap when you think about an integrated oil and refinery company. If you're buying it for the value of the assets, I mean, that's just extraordinary. They've got solid management, committed to a debt reduction program. That's, I think, a common theme across the entire energy space. They learnt their lessons from the prior bull market, where they loaded up on debt, and basically, if you could spell oil, they'd throw money at you, and all that went into capex and new production. And so, of course, you had this massive increase in supply once that capex rolled into production, and the relief from which is a falling price. Okay, demand is growing, but it wasn't growing at the same pace at which supply was coming online. Okay, and then that's a recipe for disaster, because you've loaded up your company with a heap of debt, poured out a heap of new production, and so then all of a sudden you're wondering why you can't sell your commodity for even a fraction of the price at which you used to. Okay, so you're below the break-even rate, and it's chapter 11 time. The management, it's very interesting, of basically all the major oil and gas players are saying the same thing. They said they are not going to pour a heap of capex into new production. They're going to use free cash flow, and out of free cash flow, they're going to apportion it to paying down their debt, paying a heap out as either dividends or buybacks to their shareholders, which is what they should do, is treating the shareholders as the owners of the company, which we are. And then anything left, they can look at a little bit of extra capacity moving forwards. But we really need, and there's a great article on the Twitter sphere about how we need to spend nearly $500 billion in new production in order to avoid supply disruptions. And companies are saying they're not going to be looking to debt finance that. Most of the time they can't, due to the ESG warriors and the social pressures of the minute, stopping these energy producers from getting finance. So they probably would struggle to get finance for new production anyway for an oil and gas plant, even if they decided they were willing to debt finance new operations, which of course they've said they're not. Funding growth via free cash flow. So it's all pretty solid, fundamental, and exactly what we want to hear in terms of management using their funds responsibly and rewarding shareholders whilst maintaining the integrity of the supply-demand ratio for the bull market. Okay, so this combined company will be one of the largest Canadian integrated oil and gas producers, as we mentioned. So if you look at Suncor is a good example. Everyone seems to have heard of Suncor. If we're taking Cenovus here, the old entity, and combining their production in with Husky, which they've just acquired, they're going to be right up there with Suncor, okay, in millions of barrels of oil equivalent a day. And so when you look at the discrepancy between the values of Suncor and the new Cenovus Husky entity, by rights, we should be looking at it more on the valuations of Suncor, because it's going to be almost as big of a producer with refining capacity. And that's the refining capacity on the right-hand side of the page here in terms of the amount that they can put through. And it's very, very interesting to see that the two combined there. This would be the new pro forma entity. Move me out of the way, and it gives you an idea as to how much production they can refine on a daily basis moving forwards. Okay, I understand this is a hard chart to see, but it's important nonetheless. This is taken from Eric Nuttall, 9 Point Partners, a fund manager who specializes in Canadian oil and gas plays. Okay, so if you look at these charts, it's quite incredible. If you look at, on the left-hand side, he's broken it down using $70 a barrel WTI, and then on the right, he's used $80 WTI. What would that mean for the particular companies on that plot moving into next year? Okay, so here we're looking at debt to cash flow, and as you can see here, it's just incredible. There's Cenovus Energy, okay, and so the debt would be, as a debt burden, would be less than 1 times the expected free cash flow moving forwards into 2022. Okay, they're going to have mountains and mountains of cash moving forwards. So the fact that they're a little bit higher than our normal 3 times net debt to EBITDA, we can justify looking at this from a next year's perspective in terms of the amount of free cash flow that they will have to service their debt. And of course, with oil at $80, which it has just ticked over to $80, you can see Cenovus in amongst the pack there. I'll draw a little circle with my cursor with a debt to cash flow at less than 0.5. Okay, it's just insane to see some of these major energy producers, where we're moving into an energy bull market, that are being priced so cheaply. It's quite astounding. Management certainly believes in the story, so here's a quick look at insider buying. Okay, as the great Peter Lynch would say, management can sell shares for any number of reasons, but they only buy for one, and that's a very telling proverb, if you'd call it a proverb, from the great Peter Lynch. We've got $1 million almost Canadian in the second quarter of this year, with insiders buying up more shares. Okay, so they certainly believe in the story of the company. They know presumably where they're heading, and they're happy to bet their own money on the new business. So here's a look. So I mentioned Suncor before. If you look at Ovintiv, which we also own, and you look at Cenovus, here we have over the last year the price action of the 3 entities. And so that's telling a tale. Ovintiv being mainly more of a United States energy play, and Cenovus being my pick for the Canadian oil and gas sector. It'll be interesting to see how that pans out moving forwards. If we take a longer 12-year view, okay, you can see at the prices at which these companies used to trade, okay, so we've got a long way to go before they reach their historic upside, and that is exciting for us because we do believe that oil will hit I believe oil will hit $100, if not next year, maybe the year after, because we just don't have the same supply coming online that we did in the massive oil bull market around here between these years, where oil was closer to $140 a barrel. And so, all things being equal, we've got Cenovus down here. They've got the most upside in terms of the retracement, and oil prices continue to rise. The companies are not investing stupid amounts of debt finance into more production, so supply is going to be tightening, prices will stay stable, and these companies will be printing mountains of free cash. Okay, looking into 2023, here are the estimates that analysts have given us for 2.25 years out. Okay, so we're going to call it 2 years for the sake of calculating the time value of money. We've got our projections for free cash flow per share, EBITDA on a per share basis, and earnings, which is not good to use for many reasons. I've spoken about this a million times. It takes into account a hell of a lot of non-cash costs, and so will always drag down your estimations. Anyway, we'll put it in there. So we've got our multiples. These have been taken. Looking at historic means is how I would normally do it. Looking at industry means is another way that you can do it. However, if this ESG crusade continues out into the next decade, which it appears that it will, and looking at a lot of Eric Nuttall's material, he would suggest that, look, when we have to value these companies as if they are not going to mean revert in terms of multiples, and we have to value them purely on their cash flow basis, and with very, very low multiples, terminal multiples attached. So that's what I've done. 5 times free cash flow is about a 20% yield. Enterprise value to EBITDA of 6 is very, very low, and a single-digit price to earnings is, of course, very low as well. We get our implied prices for each input, and then I evenly weight them and divide them, giving us an average. So we would expect over the next 2 years, if we can get an average exit of $17.44, we're looking at about 150% on the upside. Okay. That's all well and good, but we need to take into account the time consideration. Bear in mind, these companies will be paying a lot in dividends, and they'll be, or they have said that they're committed to buying back a lot of their shares. Companies like Ovintiv and Cenovus could conceivably pay, with the free cash flow they're generating, could conceivably buy back 10 to 15% of their entire float, and pay a dividend, and pay down their debt to their debt targets, which is phenomenal, and it's not taken into consideration when doing these crude valuation. So I would say this is a very, very conservative estimation as to what the price might look like in 2 years. However, assuming that we do have our average exit at that price, if we have to wait 2 years, that's a 21% IRR. So back of the envelope calculation, that is highly encouraging. I'm sure you would agree. 21% IRR is going to beat the markets in more years than not. If we extrapolate that out over the next decade, here's the EBITDA per share, and we're expecting that to continue at just its historic growth rate. So we're not even taking into account a potential energy crisis and massive growth from the bull market. Here's something of note. We're discounting it at the weighted average cost of capital for the company. These companies struggle to get finance. I mean, you talk about diversity, inclusion, and equality, and all this sort of buzzwords of the day, and yet this is absolutely discriminatory policies, meaning that these guys can't get finance for their operations they're almost at usurious rates. There's a 17% of their average cost of capital is huge. So, anyway, moving on from the politics of it all, even if we take that into account and we use it as our discount rate, and we can only reinvest at a 7% reinvestment rate, we would expect an MIRR of nearly 24%, which is huge. Okay, over the decade, that's going to turn chump change into a fortune. And same deal, but using the cash flow expected out into the future, discounted at their weighted average cost of capital, and we're looking at 25% IRR. So we're very, very happy with that. We would take that basically any day of the week, and putting it together into I suppose a more complete picture, where we use the processes mentioned before for EBITDA, earnings per share and free cash flow, but we attribute different scenarios. So we attribute, okay, a base case, a bull case, a bear case, applying a given probability for each individual outcome, and then saying, okay, what would we be looking at if we combine those times by their expected value, so what we expect for their present value times by the probability of those present values occurring. And as you can see, we get an average intrinsic value of $19.13. Our discount rate is our required rate of return, so 20% discounted rate, which is quite high, meaning if we want to achieve a 20% annualized rate of return over 10 years, and the assumptions that we've made are reasonably true and correct, we can pay maximum $19.13 for the shares. We apply the Buffett-Munger margin of safety on top of that, and we say if we're happy with that intrinsic value and we can buy it at 2/3 or less than that value, we are really ready to load up the boat. And so as you can see, $12.62, and the stock's trading at less than $12. It's really in our buy zone. So I'll be looking to make the most of that. A quick side note on that, Buffett-Munger generally use 10% as their discount rate. Okay, so we're applying multiple margins of safety in terms of the discount rate in which we use, and also a 2/3 margin of safety at the end. So we're going a little bit over the top, and we just need to bear that in mind, that it's probably a little bit overly conservative. So the verdict, of course, is a buy. Okay, it's got low enough debt. I wouldn't say it has low debt arbitrarily, but it has income to debt ratios are fine, especially seeing as though they've survived the worst of all scenarios. If you're an oil producer and oil futures go negative, it's not going to get much worse than that. Margin of safety is there, sales growth, strong margins, free cash flow growth, and share buybacks are absolutely going to be there. I took an initial stake of 1.5% of the fund, but I've actually doubled that up to 3%, and I'll actually be looking to divide that between Ovintiv or to take profits off the table from Southwestern Energy. I don't like what they've done with the hedging of the gas prices, and so we'll take the profits. We've made a nice profit from Southwestern, and we'll be rolling that capital into a mixture of most likely Ovintiv, Cenovus, and possibly a little more on Transocean for reasons which I've mentioned in a previous video. Thank you so much for watching. Please like and subscribe to the channel. Help me get the word out there. And if you're not already following us on eToro, click on the link and we'll be taken to the portfolio. You'll be able to keep up to date with how we're tracking and what we're buying. And if you would like to share in the gains and you like the way that I invest, all you got to do is download the app, go to the link and add some funds, minimum of $200, okay? And you can take it in and out as you please. But that's the rundown. You guys know what eToro is, I'm sure. Quick disclaimer, you're responsible for your own decisions. I'm not your financial advisor, and none of this is advice. It's just my thoughts and what I'm doing with my particular funds. You should always do your own due diligence and make your own decisions, and of course with that comes accepting the responsibility and the consequences of the outcomes of those decisions. I wish you all the best, and I'll be back with another video shortly. Thanks for all the support. I really appreciate all the comments and engagement that I've had on the channel. It's given me the encouragement to continue to do it, and so I'll continue to do it until we don't get the engagement, basically. All the best, guys. I'm going to shoot off, and I'll see you in another video.